Good afternoon, everybody, and thank you for assisting to this webinar presented by SSQ Insurance. My name is Matthew Roy, Investment Fund Analyst here at SSQ. We are pleased to welcome today John Shutter, Vice President, Consumer Service and Business Development, here to talk to us about the Beutel Goodman U.S. Equity Strategy. Please note that if there is enough time at the end, it'll be our pleasure to answer one or two questions that you can ask via the Q&A sections of the WebEx interface. You can also communicate with your SSQ Insurance representative for all other questions. So without further ado, John, the floor is yours.
Thank you very much, Matthew, and I hope you can hear me. If not, let me know now.
Yes, I can hear you.
Perfect. Good morning, everyone. My name is John Shutter, as Matthew said, and I'm pleased to present our American Equity Fund overview today. I'm going to give you a brief overview of the firm, the people, and our process, and then I'm going to talk about portfolio construction, and I'm going to give you a few descriptions of the companies we're invested in, 7 companies to be exact, and then I'll give you our current strategy and outlook. So, to begin with, the firm was established 51 years ago by Austin Beutel and Ned Goodman, 2 value investors. And Austin Beutel is still in an office on the 19th floor, although he did sell his shares in the firm in 1991. We are still private and independent, the largest private independent pension fund manager in the country, but we also manage money for estates, foundations, trusts, corporations, etc. And our investment philosophy since the very beginning is based upon absolute risk, the value of losing money effectively, and sustainable returns. We currently manage $40 billion in assets, and we are very concentrated in stocks, bonds, and balance funds. We don't do indexing, no commodities, no ETFs. And the most important thing, the last point on page 2, is our strong client-centric culture. So our clients absolutely come first. That is the most important thing. And we're a small team, although we manage $40 billion. So if you look at the next slide on page 3, you'll see on the left-hand side, we have 10 investment professionals in the equity division. We don't need a lot of people. We run very concentrated portfolios, and our universe is very small. We are looking for sustainable businesses, so we don't have a lot of cyclical bent, if you will, and companies that generate free cash flow, sustainable free cash flow. There are a limited number of them, especially those companies where management is able to give that money back to shareholders through wise investment decisions and dividends. If you look at the team, the industry experience, very experienced individuals. All the analysts are portfolio managers. We don't have, if you're the analyst, you are also the portfolio manager. So average experience is about 23 years, and the average tenure at the firm is close to 13 years. On page 4, you can see the American Equity Fund we currently manage, and the one I'm going to be talking about today. We've been managing for SSQ since 2015. We also have a Canadian equity and a small cap fund on the pension side. All of these funds and all of our funds are managed the same. So whether you're an estate, a trust, a pension plan, it's all managed by the same model. So the American Equity Fund, whatever platform you're on, is the same. The Canadian Equity Fund and the small cap fund. On page 5, our philosophy. And preservation of capital is paramount. And I've been in a number of discussions with many people this year, and I bring it up quite often with people just to make sure that everyone understands what that means. Preservation of capital. Preservation of capital is the ability to preserve the value above inflation. So when you think about that, you have to look at making sure that the capital that you have is preserved above inflation for periods of time. And that's what we focus on by investing in businesses that have sustainable free cash flow. So as I mentioned, there won't be a lot of cyclical businesses like the likes of materials or energy businesses compared to benchmarks. Typically, we're underweighted in those. And the last 3 points on page 5, we will only buy a business when it's trading at a discount to its business value with a minimum return over 50 a requirement of 50% over 3 years. And we believe that low valuations outperform high valuations, and that's particularly important today as value investors were finding opportunities to buy new positions in the portfolio, and the discrepancy or the spread between value investments and growth investments is the highest it's been in many, many years. So we're finding opportunities and we're buying cheap businesses. Page 6, what the firm is all about is our ability to analyze businesses. We have a great team of analysts, and they're capable of following the research standards. So every business we look at has to be analyzed on the same basis. So on the right-hand side of the page, you can see the fundamental analysis drivers. And then on the left hand, at the bottom of the page, the 3 most important points that the firm, your clients, our clients are focused on. What price are you buying the business at? What's your upside, your target price? And how much money can you lose, your downside? And we typically look for 3 to 1, upside to downside. There's no point in having 100% upside if you've got 100% downside in the business. That's not what we're looking at. We're looking at that sustainable free cash flow business, as I mentioned. Page 7 is really the crux of the investment process for us and a key differentiator. And right in the middle of this slide, you can see 1/3 sell. Our key differentiator as a value manager is the fact that we are forced to take profits when a business reaches its target price. So I mentioned on the page before, we have a minimum 50% return. When we're buying, you can see the buy price, the buy line at the bottom. We're buying the business value, the market value, which is not the same as the business value. You can see the business value, that gold line goes up in a nice 45-degree angle over time. That's actually really idyllic. It doesn't actually exist. But we've got the ability to buy businesses that are trading at discount, a 30% discount, which gives us a 50% return, but we automatically sell at the target price. And that's absolutely critical because historically, businesses don't trade above their value for extended periods of time. And we believe in the current market context in technology businesses that many businesses are trading substantially above where they should be trading, and the market will appreciate that at some point in time. So we automatically take cash off the table and then reinvest the proceeds into businesses where we have upside. And why is that important? And if you look at the next page on the deck, on page 8, in our view, and over 50 years, we proved it with consistent value-added returns, that sell discipline supports excess returns. And you can think about it, it harvests bull market upside. And bull markets don't last forever. There are corrections for one reason or another. So the sell discipline captures the favorable pricing inherent in a bull market. People are paying up for a lot of businesses. And in 2006 to 2008, we were selling businesses because they were fully valued, a lot of materials, energy businesses. We couldn't find anything to buy, and cash built. That selling also mitigates risk in a bear market, and this is extremely important. The sell discipline provides downside protection in a bear market by eliminating stocks trading at a premium to their business value. So very, very important. And at the end of all of this, you think about it, it removes the ego and the emotion out of the investment process. When stocks are falling, people are nervous. But if you have a disciplined investment process and you know the value of the business that you're investing in, you can take advantage of those market opportunities. And we do as active investors. So that's the overview of the firm, the people, and the process. And now I'm going to talk to you, moving on to page 10, about the portfolio and the concentration of the securities within the portfolio. So page 10, just a brief map of the total portfolio, if you will. We're not focused on small cap, so capitalization above 1.5 billion. Very concentrated. I mentioned 25 to 50 names. Are currently 28. When we buy a position, it's got to be meaningful. A minimum 1. Typically, it's 2 to 2.5. mutual fund rules indicate we can't go above 10%, so a maximum single holding of 10. If we don't like a sector, we won't invest in it. We're currently have no investments in pipeline, utilities, or real estate anywhere in the world. And we don't want to get too much in love with any sector, so sector weights plus 10%. So that keeps us focused on not going too far in one sector. Cash, minimum 0, maximum 15%, and we don't trade. So when we take a long-term view on a business, we hold that position, and the annualized turnover is between 20 and 30%. So here we are on page 11. Here's the portfolio. I'm going to talk to you about 7 companies within the portfolio that will represent close to about 30%. And this is where I'm going to spend the majority of the presentation now. And I apologize, we're just going to stay here and look at these names, which we look at every day, but I thought I'd give you a bit of a heads up on some of them. So as of September 30th, there were 28 names and less than 1% cash. And the only time cash will build in the portfolio is when we are not able to find significant investment opportunities with good potential total returns and lower downside risk. And we are finding new opportunities to invest. In the third quarter of 2018, we added Kimberly-Clark and KLA-Tencor. So Kimberly-Clark is a global manufacturer of paper-based consumer hygiene products. So think diapers, toilet paper, Kleenex, personal care, consumer tissue, and workplace paper products. The company has about $18 billion in sales across 175 global markets, and 75%, 5 of its largest brands account for 75% of total consumer sales. And it is either number 1 or 2 in 80 countries, position number 1 or 2. So I'm assuming you've heard of probably the Kimberly-Clark or the products that they have, but maybe not KLA-Tencor. It's a leading supplier of process control, alignment, and defect inspection technology used in the manufacture of semiconductors. Not a sexy business for sure, but it is one of the top producers of those components. Those 2 positions are new, as I said, in the third quarter of this year, and each one is at a 2.5% weight within the portfolio. The largest weight in the portfolio is Verizon, 6.2%. It's also one of the largest overweights in terms of the industry sectors, 6.2% for the old telecommunications index versus 2%. And I would reemphasize at this point that we do manage very concentrated portfolios. So Verizon is the world's 2nd largest telecommunications company by revenue, behind AT&T. It operates almost entirely in the U.S. and is the largest wireless provider to around 100 million customers. Verizon provides voice, data, video service to over 10 million households with its own fiber optic network. And the jewel in this company's product line is the advanced 4G LTE wireless network, covering over 300 million people. We recently added Comcast in the spring of this year, and it's now a 4% position in the portfolio. It's the largest cable company in the U.S., and owner of sizable media assets, including NBC and Universal Studios. Comcast Cable provides video, broadband, or voice services to over 25 million residential customers, 2 million business customers across the U.S., and over 30% of their clients take all 3 of the products, so well distributed, fingers in all the pies, so to speak. The penetration rate varies by product, with 39% of homes passed taking video, 45% of homes passed taking broadband, and 20% taking voice. NBC Universal, I'm sure you've heard some of the Universal Studios, its theme parks, cable networks, broadcast television, and filmed entertainment. A great business, AmerisourceBergen, a significant weight within the portfolio as well, at 5.5%. AmerisourceBergen is the largest drug wholesaler in the United States, in an industry where the leading 3 players control 85% of the market. Basically two businesses, Amerisource Bergen Drug Corporation, full-service distributor, branded generic and specialty pharmaceuticals, and Amerisource Bergen Specialty Group. It's the largest U.S. distributor of specialty pharmaceuticals, which includes plasma products, dialysis, and vaccines. AutoZone, 4.9% weight in the portfolio, similar to Canadian Tire. Great locations, great business. You may know that, as I say, similar to Canadian Tire. It's the largest retailer of automotive replacement parts and accessories in the USA. 80% of the revenues earnings from sales to the retail, also known as do-it-yourself driver, making auto repairs at home. It also derives 9% of operating earnings internationally, mostly from Mexico, a small amount from Brazil. It is the number one retailer in auto parts to drivers with 15% market share, so a great business. And the top four players in the United States only have between 6 and 6.5% of the total market, and AutoZone is the largest. Amdocs, 3.9%. Position in the portfolio, and it's a great example of the type of technology businesses we're looking for. Amdocs is a global leader in billing software and outsourced IT billing services across the telecom and cable industry. The company supplies software and runs the billing platform for all of the leading telecoms in North America, except for Verizon and T-Mobile. And its customer list will include Bell, Rogers in Canada, TELUS in Canada, AT&T, Sprint, and Comcast. Outside of North America, Amdocs is building and has recently signed contracts with Vodafone and Telefonica. We like these types of businesses, basically enterprise software applications, and they include businesses like Oracle and Symantec. We don't own a lot of the FANG stocks that have been recent market darlings because of valuations. As I mentioned at the beginning, the difference between growth and value, the valuations are some of their highest they've been in years. As value investors, we're searching for companies that have sustainable free cash flows that return that cash to shareholders and are trading at appropriate discounted valuations. Today, many of the top-performing technology stocks do not meet our criteria for investment, and that is reflected in our current significant underweight in the technology sector. We have no investments, as I mentioned earlier, in either the real estate or utility sectors due to valuations, total return calculations that we believe are too expensive. I would also point out that the companies in the portfolio, which are smaller weights, are either just being acquired or have reached their target price and are just being sold from the portfolio. The final slide, page 12, if you go there, you can see, yes, page 12, it refers to our relative weights. And as I mentioned at the beginning, we don't have to be in a sector, utilities and real estate. We have absolutely no areas. Cyclical businesses like energy and materials, where materials is a little bit overweight. It's a little bit different in the United States versus Canada, but typically underweight in energy within the portfolio. Today, cash is low, and I want to remind you that the only time cash will build is when we are not able to find new investment opportunities, and we are able to do that, as I mentioned at the beginning, with the KLA-10 core and the Kimberly-Clark recently added to the portfolio. We are currently able to recycle our cash from securities being sold to securities where prospective total returns are appealing. So I thank you for listening, and we'd be pleased to answer any questions, and we'll hand the mic back to Mathieu.
Okay, thank you, John. The only question we have so far concerns the utilities sector. Those utilities give a good dividend return. Why do you choose not to have this section in the portfolio?
Well, and anywhere in the world, you're absolutely right. They do have good current yields, but we're looking for a total prospective return, which includes a capital appreciation. And those businesses are, in our view, are overvalued and have been overvalued for years based upon people seeking the near current yields. So for us, they're expensive. When you look at the valuations in telecommunications, on the other hand, on a global basis, the prospective total return of those businesses is significantly less. So, and the balance sheets are better, and we believe management focusing on returning capital to shareholders is better. So, overweighted the telecommunications and underweighted the utility sector significantly. Hello?
Oh, sorry, John. We have another question. I'm not sure if you can answer that. Somebody wants to know if you have a view on recession coming soon or not.
So it's a good question. And if you come to Beutel Goodman, you'll see that we do two things, or as I said at the beginning, three things: stocks and bonds, and then put them together to make balanced funds. So when you're looking at stocks at Beutel Goodman, it's all bottom up. So when you're looking at bonds, it's all top down. When you're looking at bonds, you're looking at interest rates, you're looking at central banks and where they peg interest rates. So the fixed income team is calling for a recession potentially sometime towards the end of 2019 or thereabouts in North America. But is that going to affect the business-to-business valuations? A lot of times it may or may not. So when you look at the businesses we're buying, we have to look at it from the standpoint of the businesses themselves. Whether or not there's a recession or not, is that business going to do well, and can it do well in those environments? So there may be a recession towards the end of 2019, but we're constantly looking at the data to see whether or not that is going to be the case.
Okay, great. So we don't have any other questions for the time being, so this would conclude the presentation. To all of you who listened to the webinar, thank you for your participation, and come back in January for our next webinar. So thank you, everybody. Have a good day.